Have you ever wondered what it looks like when a single piece of new tech sends Wall Street into a complete and utter panic? Well, it looks a lot like one specific day in May of 2024, a day that honestly might have just changed the game for the entire software industry.
Just take a second and look at this number. $285 billion. It's a staggering amount of money. Kind of hard to even wrap your head around.
And poof, just like that, it was gone, wiped out in a single trading day. It was a massive financial shockwave that you could feel ripple all the way across the globe.
Which, of course, led everyone to ask the exact same simple question: why? What on earth could cause a panic this big, this fast? So let's get into it. It all started out looking like a totally normal day for the markets, but it very quickly spiraled into a historic plunge for the entire software sector. The thing that's so wild here is just the sheer speed and scale of it all. This wasn't some slow decline. It was an absolute explosion. A massive sell-off that didn't just stay in the US. No, it spread like wildfire over to markets in Europe and Asia, which just goes to show you how jittery and connected the whole global system really was. So what was the match that lit this $285 billion fire? Well, it was a brand new AI tool with a pretty scary-sounding nickname. Yeah, they called it the SaaSpocalypse. It came from the AI company Anthropic. Now, SaaS, that just stands for software as a service. And, well, you can probably guess from the rest of the name that its release was seen as something of an apocalyptic event for that whole industry. And this really gets to the psychology of the whole panic. The tool itself, it didn't actually break anything, but its potential, that's what was so terrifying to investors. It kicked up this immediate, almost existential fear that the business models of countless software giants were all of a sudden totally obsolete. And that brings us to the real issue here, because that SaaSpocalypse tool, it was just a symptom. The real disease that investors were freaking out about was this fundamental crisis in how software companies actually make their money. For decades, this has been the bread and butter of the industry, seat-based pricing. It's super simple, right? A company has 100 employees using some software. They pay for 100 seats or licenses. The more users you have, the more money you make. Simple. But what happens when AI crashes the party? This breakdown shows the core fear perfectly, so let's just walk through it. Imagine a company paying for 100 seats for their team. Then, bam, a new AI tool comes along that makes that team 5 times more efficient. Suddenly, they only need 20 people and 20 seats to do the exact same amount of work. For the software company, that's an 80% drop in revenue from that one client, like overnight. Now imagine that happening with thousands of their customers. Yikes. So this deep-seated fear, it caused this profound and really immediate shift in how investors see the entire software industry. This wasn't just a sell-off, it was a total rewiring of their mindset. And to really get a handle on this new reality, an analyst from JPMorgan, Toby Ogg, he went right to the source. He talked with over 50 major investors to really get a feel for the room. And what he found was pretty bleak. This quote, wow, it just nails the new mood perfectly. I mean, think about it. The software industry always got the benefit of the doubt. But now, in the age of AI, it's being punished ahead of time for crimes it might not even commit. The fear of what could happen is so strong that investors are just selling first and not even bothering to ask questions later. This new psychology means the old investor playbook is basically in the trash. It used to be so simple. A software company posts good earnings, the stock goes up. Easy. But in this new playbook, even amazing results aren't enough to calm everyone's nerves about the long-term threat of AI. And Ogg's research totally confirmed this wasn't just a one-day thing. Turns out the mood had already been getting sour for over a year. And here's the key part. Even after this massive $285 billion price drop, almost no one was seeing it as a bargain. They weren't buying the dip because they were terrified the dip was actually a cliff. So where does that leave the software industry? Well, it leaves them in a really tough spot, where they have to play by a totally new set of rules if they want to earn back any trust. The bottom line is this. The burden of proof has completely flipped. It's no longer up to investors to believe in a company's future. Nope. It is now 100% on the company to prove, beyond a shadow of a doubt, that they have a real plan to survive and even thrive in this new age of AI. So what does that proof even look like, right? What's the new bar that these companies have to clear to get Wall Street back on their side?
This right here is the new mandate. A software company can't just throw AI strategy into a presentation anymore. They have to show with cold, hard numbers that AI is actually going to help them make more money, that it's a tailwind pushing them forward. They have to prove that AI won't become a headwind that just eats their business model alive. The market won't accept anything less.
All right, so let's just do a quick recap. A single AI tool release sparked a massive global market shock. But the real fear wasn't about the tool. It was about AI's potential to completely shatter the classic seat-based business model. This has totally flipped investor psychology, creating a new guilty until proven innocent reality where companies have to prove AI is their friend, not their enemy.
Which leaves us all with the big, multi-trillion-dollar question for this entire industry. Is AI the ultimate partner that's going to create more value than ever? Or is it the ultimate replacement, here to make all the old ways obsolete? For now, Wall Street seems to have placed its bet. I guess we'll just have to wait and see if they were right.